Despite alarming news headlines and surging current inflation data, most markets and investors to this point appear unconvinced that inflation will remain at these levels. In fact, expectations for future inflation are relatively benign and look much more like pre-pandemic inflation than what we are seeing presently in the data and trends. So are investors being overly complacent about inflation? And if they are, what could that mean for bonds, stocks, and commodities? Let's take a quick look at each of the three. Bonds are probably the most straightforward, so we'll start there. In short, higher inflation typically means tighter interest rate policy from the Federal Reserve and higher overall bond yields. Since bond prices move in the opposite direction of interest rates or bond yields, that would imply that all else being equal, as bond yields rise, bond prices and returns would generally fall, at least in the short run. It's important to point out that while higher yields might mean negative returns for bonds, it doesn't have to. How much and how quickly rates or yields rise will play a large part in determining if bond returns are negative or just lower than expected. It's also worth noting that higher yields allow new money to be put to work at more attractive levels. So what may be a short-term negative can also be a long-term positive. It's probably no surprise, but the impact of higher inflation and interest rates on stocks is much more complicated. It's very difficult to make broad assertions as the impact to businesses varies tremendously by industry and each company's ability to pass along price increases to their end customer. Even though it is difficult to make broad comments, there are two things we think are worth mentioning. First, historically speaking, stocks do best with low and stable inflation, but they can still do well at moderate levels of inflation. It's typically at the extremes that stocks perform poorly, meaning that negative inflation or very high levels of inflation are bad for stocks. Second, as value investors, we can't help but think about what higher inflation and interest rates would do to stock market valuations. The earnings multiple that investors have been willing to pay for stocks has expanded from 15 times to around 25 times since just before the financial crisis. That increase is in no small part due to the low level of interest rates we've had post the financial crisis. So it only seems logical to think that rising rates might reverse that trend and become a headwind for stocks going forward. Lastly, on commodities. We know that they are generally viewed as good inflation hedges, but we caution investors against assuming that history will simply repeat itself. Investing in commodity markets typically means investing in futures contracts, a route that is very different than investing in stocks or bonds. In fact, a rather significant portion of historical returns for commodity strategies can be attributed not to the moves of the commodities themselves, but to things like collateral and contract roll yields, two return components that look very different today than they did the last time inflation was high in the US. If you have any questions or would like to discuss your personal wealth management needs, please contact us at the email, address, or phone number at the close of this segment. Thank you.